So we had our first negative 1% day in the stock market for the first time in almost 2 months for the first time since the 27th of March. The stock market dropped 1.2% last Friday, and let me tell you right now, your favorite financial gurus on this app are probably having a collective panic attack in their air-conditioned offices. They are sweating through their designer suits, screaming about the end of the world, and telling you to liquidate everything into gold bars, but we do things a little differently around here. We do not trade on feelings, we do not trade on panic, and we definitely do not care about your emotional well-being when there is cold, hard cash to be made. If you actually watched my last Sunday video instead of scrolling through mindless dance videos, you would know that I explicitly told you I was starting a position in MRAM. I told you exactly what the play was, but honestly, I expected this position to take a little bit longer than it did to actually mature. Instead, the market decided to hand us an absolute banger of a week. We were up 160% on this position within just 7 days because MRAM's market cap went from 400 million to over 1 billion in the blink of an eye. So I happily closed that position, pocketed that beautiful 160% gain on MRAM, and now I am sitting on a pile of cash ready to deploy it while everyone else is still trying to figure out what happened. If you missed it, do not come crying to me in the comments section asking for a time machine because I am going to give you a complete step-by-step blueprint right here as to how to tackle the market going forward. This is the ultimate no-nonsense guide to everything that you need to watch out for this week and exactly how to take advantage of it from both a trading and an investing perspective. First of all, let us address the elephant in the room because we are officially coming up on a historically bearish time frame for equities. If you look at the historical data from May to October in midterm election years, the stock market tends to see a massive correction. The historical average for this specific window is a painful decline of minus 10 to 12%. But before you go selling your house and burying your cash in the backyard, I want you guys to recognize something very important here that the average bear completely misses. There are no years in that specific historical data set ending in the number 6. If you go back and look at 1986 as well as 2006, those specific years were actually positive for the market. And obviously right now in 2026, we have a year ending in the number 6. Sure, that is a very small sample size of just 2 decades, but it proves that blindly following historical catchphrases like sell in May and go away is a great way to stay broke. Historically, May to October in midterm election years tends to be a pretty bearish time frame, but we have some unique moving parts right now. Let us talk about the absolute circus happening over at the Federal Reserve because we have a brand new Fed chair that is supposed to start soon. But because Washington loves bureaucracy, the Fed officially named Jerome Powell as chair pro tempore until Kevin Warsh is officially sworn in. And right now, there is no official date for Warsh being sworn in, although I believe he was already confirmed by Congress. So the actual swearing-in date has not been set in stone yet, which means Powell will remain basically the de facto Fed chair until we have that ceremony. Why does this matter to your brokerage account? Because history shows us that we tend to see a notable market pullback during the first few months of a new Fed chair presidency. The institutional algorithms and Wall Street trading desks love to test the new Fed chair to see if they will bend the knee or stay hawkish. Then we have the geopolitical theater. There was a major summit between China and the US last week, and China came out stating that it reached a tentative agreement with the US on some tariff reductions and trade cooperation by committing to buy a bunch of commercial airplanes. But they also threw a massive amount of shade at American big tech. They explicitly said that even though the US government finally allowed them to buy the high-end H200 chips from NVIDIA, they are simply not going to buy them because they claim they do not need them. I do not know if that is just classic geopolitical grandstanding or if they are actually making progress on their own domestic silicon, but it is a massive statement. And speaking of NVIDIA, you might want to cancel your Wednesday dinner plans because we have NVIDIA earnings dropping on Wednesday after the closing bell. Now, if I had to bet my own capital, I believe that they are going to absolutely crush earnings. They are going to beat revenue expectations, and it will likely be another record-breaking quarter for Jensen Huang. But let us be real for a second. Nobody cares about the past quarter anymore. Everyone on Wall Street is going to be hyper-focused on their forward guidance. If that guidance shows even a hairline fracture in AI demand, the market is going to rip this stock apart. We also have the massive SpaceX IPO coming down the pipeline, but that is a story for later next month. Now let us talk about how to actually trade this volatility instead of just staring at your screen like a deer in headlights. I previously told you guys about using the 921 EMA street strategy on the AI build-out stocks, and I gave you a specific list of tickers to watch, by the way. If you want the full breakdown, I have a complete list for you of all of the stocks that I am personally tracking from an AI build-out perspective. If you just click the link in the description below, I will send you that exclusive PDF absolutely free, so make sure you grab that right now. But going back to the technicals, I said that you can actively swing trade these high flyers right off the 921 EMA, And if you actually followed that tip from the last video instead of ignoring it, you would have made a killing. Look at ALY, for instance, which is a key photonic stock. You can see right on the chart that by trading off the 921 EMA just last week, the stock exploded up 53% in a matter of days. Same exact thing happened for Light, which is Lumentum Holdings. If you followed that specific tip from the last video, Lumentum Holdings was up a beautiful 21% following the exact same technical setup. Coherent, which is another massive photonic player, did the exact same thing, jumping aggressively right off the 921 EMA. As I have said a million times before, you want to aggressively ride and take advantage of this macro trend until the trend is no more. I do not care what the historical statistics say about midterm election years when individual companies are printing money. A lot of these micro-cap and mid-cap tech stocks are not even in the SP 500 or the NASDAQ. So they do not care about index fund flows. The current institutional cycle is hyper focused on photonics and data center infrastructure. Look at Nebius, which also made an absolute all-time high again last week, bouncing perfectly off that 921 EMA line. Now, let us establish some strict risk management here. If this technical trend breaks, then yes, you immediately stop doing this because the trend is your friend until the very end. But until that line officially cracks, you keep running the playbook. When the trend breaks, that is your explicit signal to let your foot off the gas a little bit and rotate your capital. Speaking of rotation, we might be seeing the early stages of a massive move into software. If you look at IGV, which is the tech software ETF, it is currently up a quiet 25% since the 10th of April while nobody was paying attention. I actually just did a comprehensive research write-up on ServiceNow, providing my complete investment thesis for the company if you use AlphaScope to analyze their free cash flows, their cash from operations, their EBITDA, and their top-line revenue. The numbers look like a textbook linear graph. It honestly looks too good to be true. But ServiceNow is a powerhouse company that is growing by every single important financial metric you want to see at a highly consistent pace. Huge shout out to AlphaScope for making that data so easy to digest. By the way, sign-ups for AlphaScope are now officially open at the introductory rate of just $19 a month. It drops down to $16 and change if you bill it annually. But at some point very soon, prices will be going up significantly. So make sure that you lock in that low rate right now if you want to use the absolute best fundamental tool in the entire market. But seriously, look at the software sector. Microsoft looks like it wants to break out to new highs, although it did drop a little bit after hours on Friday when the headlines announced that Bill Gates had sold his entire remaining position. To me, that headline is a complete non-issue. Bill Gates sold the vast majority of his Microsoft stock a long time ago. In fact, he famously missed the opportunity to become the world's first trillionaire because he liquidated his Microsoft shares way too early before this massive pump to the mid-500s. So, for me, Bill Gates selling his last remaining pocket change of shares is irrelevant. He already missed the AI pump, so do not let the mainstream media scare you into thinking he knows something you don't. If we do get a deeper dip on Microsoft or the SP 500, that is going to be an absolute gift for long-term investors. The SP 500 is currently on a massive 7-week win streak, and historically, 52 weeks after achieving a streak like this, the SP 500 has never been red. Now, I am always 100% honest with you guys, and I will be the first to tell you when I do not know something. So, is the SP 500 going to see a massive 20% correction right here? Personally, I do not think we are going to get a standard catastrophic correction right now just because we had one red candle last Friday, but I do think that the market will actively test the Federal Reserve, especially after the first new Fed meeting or two with the new leadership. So, yes, we will see a real correction at some point later this year. I just do not think that correction officially starts today. But if we do get a 5 to 10% pullback, that is a 100% viable buying opportunity for your long-term portfolio. The AI build-out is still fairly early in the grand scheme of things. There is still plenty of market euphoria left to burn through, and I think the market will likely see a massive blow-off top rotation into software stocks before we face a legitimate bear market, probably sometime in 2027. I do not think the macro party ends until the software sector completely flies into the stratosphere. However, we have to look at the ugly side of the macro data because crude oil is still hovering stubbornly above $101 a barrel. The shipping issues in the Strait of Hormuz are not solved whatsoever, and things are actually getting more tense. This sticky energy inflation does not bode well for the equity market long term. With the market spending almost 2 full months with crude oil hovering around the $100 mark, a severe recession is almost guaranteed at some point down the road. We are already seeing the domestic CPI numbers come in at levels we haven't seen since the height of the pandemic. Headline CPI just came in at 3.8%, which is the highest level we have seen since May of 2023. Core inflation also rose to 2.8%, which came in hotter than Wall Street expectations of 2.7%. But the absolute worst macroeconomic numbers of all came from the PPI report. The Producer Price Index completely surged to a staggering 6%, completely destroying the analyst expectations of 4.9%. We literally haven't seen wholesale prices rising this fast since January of 2023. Core PPI came in at 5.2% against expectations of just 4.3%. The longer these insane wholesale prices sustain, the longer the Federal Reserve is going to be forced to keep interest rates high. They are not going to be able to cut rates this year. In fact, while I do not think this Fed wants to raise rates, the mathematical chances of a rate hike are officially higher than a rate cut. Because of this sticky inflation data, the chickens will eventually come home to roost, and the economic pain will likely hit us full force in 2027. So, knowing that the macro clock is ticking, you are going to have to play this market incredibly tightly. You cannot just buy random stocks, close your eyes, and hope for the best anymore. You need to know exactly when to take profits, when to hedge, and when to put your foot flat on the gas pedal if you want real-time access to all of my comprehensive long-term analysis, as well as my personal swing trades like our 160% win on MRAM. You need to join us. The link is right there in the description below. Go ahead and get yourself AlphaScope right now before the price increase. It is the ultimate fundamental tool to stop you from buying overvalued garbage, and it will do absolute wonders for your portfolio as performance. It is only $19 a month, or $16 and change if you sign up for the full year. And don't you forget to grab that completely free PDF detailing all of my top AI build-out stocks while it is still available. I look forward to seeing you guys in the next exclusive video. Stay safe out there, traders, and let us go make some money.